If you've been watching this series, you already know the truth. Getting to your first $1 million isn't about luck. It's not about day trading either, and it's definitely not about picking random stocks. In this video, I'm showing you the exact type of investments that quietly did most of the work on my way from $0 to $1 million. They're called ETFs, and they're boring. They're simple, but they work. So if you're early in your journey, especially if you're under $100,000, this might be the most important video in the entire series. Here's something most people don't realize. The first phase of wealth building is not about being clever. It's about not messing up. ETFs help you do exactly that. An ETF is just a bundle of stocks. Instead of betting on one company, you own hundreds or thousands at once. So what does that mean? That means less risk, less stress, and fewer mistakes. This is why ETFs are perfect when you're building your first 10K, working towards your first 100K, or even scaling towards $1 million. All right, let's break them down the simple way. Total US stock market, VTI. This is the foundation. VTI owns almost every major company in the US. We're talking about Apple, Microsoft, Amazon, Google, Nvidia. When the US economy grows, this grows with it. Long term, it's averaged around 14% per year. Some years go down hard, some years go up big, but over time, it does exactly what you want. It compounds. If you only understand one ETF, understand this one. S&P 500, VOO. VOO is even simpler. It owns the 500 biggest companies in America. These are the strongest businesses with the most money and power. Historically, it's returned about 14 to 15% per year. This ETF alone has created more millionaires than almost anything else. If you're overwhelmed, start here and don't overthink it. Total World Market, VT. This ETF is for people who want maximum simplicity. VT owns US stocks, international stocks, all in one fund. You don't have to guess which country wins. You don't have to rebalance anything. You just own the global economy. This is perfect if you want one ETF and peace of mind. Growth stocks, VUG. Growth stocks are companies trying to get bigger and faster. So think Apple, Microsoft, Amazon, Nvidia. These companies focus on growing instead of paying cash. This ETF has grown faster than the overall market long term, but it drops more during bad years. And that's normal. That's the price of growth. And if you're young, this works in your favor. If you're into tech stocks, think VGT. This ETF is focused only on technology. Think software, AI, cloud computing, semiconductors. It's been one of the fastest growing ETFs over the last decade, but it's also one of the most emotional. You get big gains, big drops, but this ETF rewards patience and punishes panic. Nasdaq 100, QQQM. QQQM owns 100 large, tech-heavy companies. Most people recognize every name inside of it. This ETF grows very fast, but falls very fast too. Think of this as a growth accelerator, not your entire plan. International stocks, VXUS. This ETF owns companies outside of the United States. Think Japan, Europe, Asia. You don't buy this to get rich fast. You buy this to avoid betting everything on one country. Smart wealth builders diversify early. Small companies, VBR. This ETF owns smaller US companies. Smaller companies can grow faster, but they're also less stable. So this ETF helps during long economic cycles. It's not exciting year to year, but it definitely adds power over decades. Real estate, VNQ. This ETF owns real estate businesses. Think warehouses, cell towers, data centers, storage buildings. You don't deal with tenants or toilets, thankfully. This adds diversification and income to your portfolio. Dividend stocks, VYM. This ETF focuses on companies that pay steady cash. Slower growth, more stability, less stress. This ETF helps you stay invested when markets get scary. That matters more than people realize. Here's the key point. You don't need all 10. In the early stages, simple wins. Most people should start with one broad market ETF, one growth-focused ETF, and then invest every month. Ignore the headlines and don't sell during crashes. Please don't sell during crashes. That's how capital actually compounds. Not by trading, not by guessing, by staying invested long enough. ETFs are the bridge between working for money and letting money work for you. If this helped, like the video, hit subscribe, and watch the next episode in the $0 to $1 million series. We're just getting started, so stay tuned.